Hey guys, Daniil Kleyman here, and we're continuing the deal analysis week that Patrick kicked off earlier. You should have already seen the video that he created. That was a great video. Thanks, Patrick. And his video laid the essentially the groundwork for what I'm going to cover with you today. So before I really get into it, a little bit about me, since you probably don't know who I am, since I'm not very famous. My previous life, I spent over 6 years working on Wall Street. I worked as a bond trader, financial analyst, deal structure. I was basically a math geek. I put together a lot of really complex financial deals in my career, and Wall Street was a great time for a while, but at the end of the day, I was just a corporate slave making somebody else rich. And I'm sure you, if you have a job, probably don't like yours either. Mine was no walk in the park. So as luck would have it, around 2008, when the economy collapsed, I decided it was a good time to leave, and I became a full-time real estate investor. And I currently own and manage a $4.5 million portfolio of rental property, and it's growing pretty rapidly. I'm acquiring and rehabbing 2 to 3 deals a month, and I'm having a blast. Best time of my life. I couldn't be happier. Love real estate, and my specialty has always been numbers, figuring out every angle of the deal, figuring out where every penny goes. That's what I did in my previous career. That's really been my strong suit when it comes to real estate, is I really know how to break any particular deal down into its components, and that's what I'm going to show you today. And so, as soon as I started my real estate investment company, I started creating analysis tools for myself to be able to evaluate deals, manage my rehabs, figure out my rates of return. And after a while, people wanted to get their hands on it, so I started a software company that provides real estate analysis and marketing tools to real estate investors, and it's grown rapidly. And today I'm going to give you an absolutely free piece of software that's going to help you crunch numbers on your deals. So today we're going to talk about, number one, calculating the correct offer for residential deals. We're going to talk about why getting your offer right is so important. And again, I'm going to give you a tool that you can download for free to make that task a lot easier. But before we go any further, let me just make this point. You're only going to get value out of this video if you pay close attention and take notes, especially if this info is not already second nature to you. I know numbers and math isn't sexy. What's sexy is making money, growing a huge real estate operation, popping bottles of champagne on the French Riviera, but one step at a time. You do all that through knowing your numbers cold. Real estate is a numbers game, and you get there by making the right offers, making sure you don't overpay for deals, and by not leaving anything out of your analysis. And I'm here to help you do that, hopefully. So 3 things that Patrick touched on in his video. Number one, before you start analyzing your deals, you need to know your niche. That was a great point. I've always been a big believer in going deeper rather than wider. It's better to know one niche really well and make money in it than know 15 niches, sort of, kind of, by far. Number 2 is you need to know your buying criteria, or if you're wholesaling, you need to know the buying criteria of your wholesale buyers. And typically that means knowing what percentage of after repair value you can be at or lower in order to make the deal work. And I'll elaborate on that in a minute. And number 3, as Patrick pointed out, you need to know the correct after repair value and be able to estimate repairs properly. To get your after repair value, you need to get solid data on recent comparable sales near the property that you're looking at. And that means whether it's, creating relationships with realtors or getting your hands on a particular data feed. That is absolutely vital for you to do. To figure out the correct after repair value, the only thing that really matters is what's selling in the market. What is currently getting sold and how much for. That's the only thing that's really relevant. And to figure out repairs, if you're a rehabber already and you can walk into a property and estimate repairs in a couple of minutes, like I can, not to brag, then you're good. If you're just starting out, bring a couple of contractors with you to your jobs. Find a way to pay them back. If you end up buying the property, hire them or refer them to your wholesale buyers to make it worthwhile for them, but bring contractors to these projects to give you accurate estimates of repairs. Knowing the ARV and knowing the repair budget is absolutely vital to doing these deals. So for your niche, we're going to assume, for the purposes of this video, because I can't cover multiple niches in a short period of time, we'll assume that you're either rehabbing and flipping, or you're wholesaling to someone who is rehabbing and flipping, and the math is the same, almost. For your buying criteria, typically when you talk to investors, you or the investor that you're wholesaling to will want to be no higher than 70% of after repair value. Oftentimes it's 65 or 60. It depends on your market, your area, and your particular investment criteria. But the idea is that the sum of purchase price, aka acquisition, renovations, closing costs, holding costs, and financing costs, when all of these are put together, they should equal no more than 70% or 65% of the after repair value of that property. And I'll show you why that's so important in a few minutes. And a lot of people oftentimes ignore the closing, holding, and financing costs, but they can add up very quickly. So it's important to take those into account. And again, I'll show you in a second why this 70 or 65% number is so incredibly important. But first, let's look at a deal that I did a few months ago as an example. This is a brick rancher that came on the market. It was a foreclosure. This is a picture of when we're already started rehabbing it. We tore the roof off. That's actually one of my roofers up here on the roof. But this was a brick rancher. It was a foreclosure. It was an REO. It got listed on the market, and I ended up buying it and rehabbing it. And these are some other before pictures. People got, the people that got foreclosed on, unfortunately, had to leave a lot of their, or they chose to leave a lot of their belongings in the house, and it was kind of outdated. This is a half bath that wasn't being used. It's just completely destroyed. Kitchen. The funny thing about this house is this roof that we completely had to tear off, you could walk on it and fall through. There were literal holes in the roof. But the previous owners bought brand new kitchen cabinets. So think about the priorities of some people out there. Holes in the roof, but brand new kitchen cabinets. Living with leaks, but having a nice kitchen. It's a little crazy. So here are the numbers in this deal. 3 bedrooms, 1.5 bath, 1,100 square feet. And I love brick ranchers. If you're going to own property, brick ranchers are awesome. The asking price was $42,000. I came in and estimated repairs to be about 22 grand, and that included putting in a new HVAC system, brand new shingle roof, upgrading the electrical service, putting in all new vinyl windows, redoing completely both of the bathrooms, refinishing the floors, painting, new light fixtures, insulation in the attic and in the crawl, new water heater, new appliances, a couple of other things. Typically, I estimate the closing costs to be conservative if it's a cash deal, and I end up buying this with cash, but oftentimes I'll use private money as well. For a cash deal, a good estimate for closing costs is usually 3% of the purchase price. It's probably more on the conservative side, but it's always better to be conservative. If you're going to estimate things, if you're going to make assumptions, it's always better to err on the conservative side. That way, if you're presenting numbers to your buyer, for example, or to your banker, and in reality the deal ends up looking better, then everybody looks great. It's always best to be conservative. So, closing costs, if you want to plug in 3% of the asking price, that's usually a good assumption. Estimated holding costs for my insurance policy, utilities, etc., I estimated at about $300 a month. Again, on the conservative side, but for the purposes of this analysis, I put in 1,500 bucks. So this is how the numbers work. And again, I urge you to pay close attention, take out your calculator and do the math with me and take notes, because this is really important. If you add these up, asking price plus repairs plus closing costs plus holding costs, and again, I'm keeping financing costs out of this because it's a cash deal, your total potential cost basis is $66,700. I estimated after repair value before I bought this property to be $90,000. And by the way, it ended up appraising. It's kind of crazy, but it ended up appraising after I was done with the renovations at exactly 90 grand. So after repair value, I estimated to be $90,000, which means my total potential cost basis would have been 74% of after repair value. But I need to be at 70% or lower. So now I need to figure out what can I offer for this deal in order for it to meet my investment criteria. And so this is how you do the numbers. It's very simple. You take the after repair value, $90,000, and multiply it by 70%. If you multiply it by 70%, that gets you to your total potential cost basis of $63,000. That's your maximum potential cost basis. Take this $63,000 and subtract your holding costs, your closing costs, and your repairs. And that puts you at your max purchase price of $38,300. If this wasn't clear, pause this video, rewind it, and go back through it. It's very simple. 90,000 multiplied by 70% gets you to 63, minus this puts you at $38,300. So this is the maximum that you can buy this property for. That doesn't mean that's what you should go and offer, because it's going to be a negotiation. You want to start lower. I'm actually a huge fan of lowballing. A lot of people are afraid to go out on lowball deals. They're afraid of hurting the bank's feelings or owner's feelings. Who cares? Go get a good deal. I ended up buying this property for 32 grand. So you never want to start at your max purchase price. You want to offer lower and maybe end up here at the worst case scenario. And by the way, if you're wholesaling, then you simply need to figure your wholesale fee into these numbers. So subtract an additional $10,000 to. So if you wanted to make a $10,000 wholesale assignment fee, then you just subtract that out, and now the maximum you can offer is $28,300. So this is how the math would work. You buy it from the bank or from a distressed seller or whoever for $28,300. Collect an assignment fee of $10,000 from your wholesale buyer. Your wholesale buyer pays a total of $38,000. Puts 22 grand into renovations, closing costs, holding costs, and his total potential cost basis is $63,000. So now he's into the deal for 63, and he can flip it hopefully for 90 and make his profit. So now that you know how to do this by hand, let me show you a free tool that will make life a lot easier for you. And I'll also show you again in more detail why the 70% number is so important. Alright, so this is one of our software programs. It's called Rehab Valuator Lite. You get it for free. And this is the welcome screen. When you download and open it, this is the welcome screen that you'll see. You click on Calculate Max Offer. And this is a standalone calculator essentially that will spit out the maximum offer you can make on a deal. And you can enter up to 3 deals here, or 3 different scenarios for one deal. So let's work through this one. After repair value is $90,000. Maximum percent of after repair value in this case is 70%. Repairs are $22,000, 3% closing costs, $1,500 in holding costs. Boom! Right there you see that the maximum you can offer for this deal is $38,300. Now, should you immediately offer that price? No, because there's always going to be a negotiation involved, and you should start off lower, and this is the maximum number that you can get to in your negotiation. So start below this number. I actually ended up buying this deal for $32,000. There's nothing wrong with lowballing. And if you were wholesaling this, you simply plug in your desired wholesale profit here. And boom, now you see that the maximum offer is $28,000. And if you want to play around with some other scenarios, let's say you weren't sure about your rehab costs and you went higher or you went lower. Well, right there you see, and we'll plug in our wholesale profit here, you see a range of your max offer. So you can play around with a few scenarios. So now let me show you why the 70% investment criteria or 65% or whatever it is so important. We are assuming that your end buyer is going to be rehabbing and flipping this property. So he obviously needs to make a profit. If you go to this next screen in the software program, which is called Rehab and Flip or Hold Analysis, you can plug in this deal and see exactly how much money your end buyer or you, if you're rehabbing this yourself, will make. So we're going to plug in $38,000 purchase price. Closing costs we'll put as right here. Holding costs. And we have detailed video tutorials that you get for free as well. They walk you through every step of this. And we're assuming that this is going to be an all-cash deal. And this is actually the premium version of the software, so there's a detailed rehab budget here. But we plug in rehab budget as $22,000. And we assume it's going to take 2 months to renovate. After repair value is $90,000. And 3 months to complete the sale. So you see that your end buyer's cost basis will be close to $63,000, 70% of after repair value, and we're going to assume that he'll be able to resell it for $90,000. But now this is why 70% is so important. In order for your end buyer to sell the property, he most likely will have to list it with an agent to sell it to an owner occupant, and he's going to pay a 6% commission plus some other minor closing costs. So that's 7% right there off the top. That leaves him with a potential profit of $21,000 on this deal. But what if what if the market works against him? While he sells, while he rehabs and has the property in the market, what if the market turns and he needs to drop the price a little bit to sell it quickly? Well, if he drops it to $85,000 or if he sells it for $80,000, well, you can see how quickly his profit margin gets eroded. So it's important to be no higher than 70% of after repair value to protect yourself, first of all, to make a profit, but also to just protect yourself against losing money. What if he sells it for $90,000, but he needs to give a couple of percent towards closing costs to the end buyer, and so his projected cost of sale goes up to, let's say, 12%. Well, again, you can see his profit margin gets quickly eroded. But as long as you stay conservative with your numbers and make sure that your cost basis doesn't exceed a certain percentage, you'll protect yourself to a certain degree against anything working against you, if that makes any sense. So whether your investment criteria or your end buyer's investment criteria are 70%, 65%, I know in some markets are very competitive, and it's, in order to get the deal, you have to be higher, 75%. Well, just know what your own investment criteria or what your wholesale buyer's investment criteria are, and stick to those numbers. And make sure that you look at a few different scenarios before making offers and take every cost into account. If I was doing this deal with financing, let's say I was getting a private money loan at 8%. Well, now there are financing costs associated with this deal, and my after repair value, my cost basis is now higher after financing costs. So if you're doing these deals with financing, make sure you take the cost of financing, cost of your money into account. All of this is very important. And when you download the software, you go to our website. I've got detailed case studies on the website of deals that I'm doing, detailed tutorials that walk you through every step of the way. I mean, this is just a small sample of what our software does. With the free version, you can actually click here, show second exit strategy, and you can look at an exit strategy where instead of selling it, you actually refinance and hold it in your rental portfolio. And this will give you all sorts of numbers. This is actually my primary exit strategy. I buy with cash, renovate, then I reappraise the property, put a tenant in there, refinance it into a permanent bank loan, and hold it in my rental portfolio. And so this will spit out all the numbers for that exit strategy as well. And then if you click here, view reports, again, this is the premium version of the software, so there are a lot of reports here that unfortunately we can't give away with the free version, but with the free version you get the project summary. And this is something you can send to your wholesale buyers if you want, or use it for yourself, and this will give you a summary of the deal. So you can see here, this is our deal, right? Pay 38 grand, put 22 in, holding closing costs, total financing costs, total cost basis. This is how much you're financing. This is how much you sell it for. This is your projected flip profit, etc., etc. This, once you input a few numbers, this will spit out all the data for you. And of course, down the road, if you want to come back and you want to take a look at some of the features in our premium software, there's a lot of cool functionality here that lets you create very snappy marketing materials for your buyers, for your private lenders. You can put together full-blown presentations. I'll just quickly show you what that looks like. Let's say you were looking to raise money for private lenders. You simply put together a presentation that looks like this. And it's all done essentially for you. You've got a cover page, a marketing summary, cash flow report with comparable sales data and some pictures, a page with some additional pictures. So there's a lot of cool functionality here that you don't need to worry about yet. What I want is for you to download the free version of the software and get familiarized with using the max offer calculator and evaluating your exit strategies. And this will save you a ton of time and prevent you from making a lot of mistakes. Alright, so let's wrap things up really quick. This is what, I wanted to show you some after pictures of the house after we did a full renovation to it, and we actually ended up painting the siding white and trimming the bushes, but I don't have the last picture. But anyway, so very thorough renovation. Even for my rentals, I like to renovate very thoroughly in the beginning. That way I don't have to come back for hopefully a couple of years and do any maintenance work to these properties. They're fairly hands-free assets going forward. So we did a nice renovation. I ended up putting a tenant into this property. You can see here, nice hardwood floors. We completely redid the baths, tiled them, added appliances to the kitchen, new floor in the kitchen, paint, etc. I ended up renting this property out. So this is how the deal turned out. I paid $32,300. My repairs came in right on budget. My total cost basis ended up being $56,300. I put a tenant in there, went to a bank sent an appraiser, property appraised for 90 grand, which is exactly where I predicted. So my cost basis was 62.5% of this after repair appraisal, which is very cool because if I wanted to take my chances selling the property in the market, I could have flipped it and made a profit. I prefer to just hold property for the long term these days. So my total cost basis is here, appraisal. I put a tenant in there at $1,000 a month. I put a new loan in place for $60,000, which paid me back my entire investment. And after closing costs, I made a little over $1,000 at refi. So effectively, I have no money tied up in this deal anymore at all. None of my cash. I make about 425 bucks a month in cash flow, and I still have equity left on paper of about $30,000. So, and you can run all these numbers with our software, even with the free version. And when you go and download the software, I have case studies that walk you through this exit strategy in detail as well, and you can kind of see how I'm building my portfolio, which is pretty cool. So, what to do now? Very simple. Go download your free software. This is the link to go do it. privatemoneyblueprint.com/deal analysis. And once you're there, you'll have access to the tutorials and to a lot of content that I have. I'm going to be honest with you, there's a lot of very cool content that I already have on that website and that I add to it constantly. The amount of education, you know, I don't know a lot of people out there that give you as much education and cool content as Patrick does. I, he's a good role model for me. I try to do the same. So you'll find a lot of good information on my website once you download the software. So go to this link, get your free Rehab Valuator Lite software, and if you have any questions, there's going to be an email address there for you to send your questions to as well. And that's it. Thank you very much for watching.